Good morning. This is Arlan Suderman, Chief Commodities Economist at StoneX. It's about a quarter till 9 in the morning, coming to you from the trading floor with an update on this week's commodity markets on this Monday morning on October the 6th. It's day 6 of the partial government shutdown, and there's no end in sight right now. The longest partial government shutdown we've seen in the history is a 35-day shutdown that started in December of 2018 and lasted into January of 2019. And that cost our economy an estimated $3 billion or 0.02% of GDP. So that's why the stock market really doesn't seem too concerned about it. We've seen very little effect there. The expectation there is we're going to have rate cuts from the Federal Reserve in the absence of any inflation data prior to the government reopening again. The focus will be on the last jobs numbers that we got, and that was the private sector ADP report, which showed job contraction during the month of September. So overall, the markets feel this sense of confidence that we're going to be looking at an accelerated rate cut cycle. I think their enthusiasm for such may be a little bit overdone, but perception is reality on Wall Street. That's what they're basing it on. So how does this affect the commodity markets? Well, first of all, we did have OPEC Plus, I should say, over the weekend, and they decided to cut production to increase production less than anticipated for the month of November. They're going to add another 137,000 barrels per day. It was widely believed that Saudi Arabia was looking for a larger increase, maybe double, triple, or maybe even quadruple that level, but there wasn't enough member support for that. And some of that may be because of the decrease in prices that we saw going into last week in anticipation of a bigger hike in production, and members fearing that they would put too much downward pressure on if they increased output too much. Meanwhile, Ukraine continues to strike at Russian infrastructure, and that is having an impact on what they're able to refine. Most of their strikes are on refinery infrastructure. And so you say, okay, that's more crude oil to export. But right now, they're nearing what is believed to be capacity for exports currently. And so, can they even increase it that much more? So, that's the key question. And if they can't, and we continue to see pressure on the refineries, Russia may have to start ratcheting down output. And so, that's a concern going forward. Now, let's go back to the headlines of the day in the ag sector, and that is President Trump continuing to talk about A, aid for farmers, and B, a big blockbuster trade deal with China at the end of the month. Now, first of all, the aid for farmers. We're expected to get details tomorrow on October the 7th from the administration on what that aid will look like. Generally believed to be between 10 and 14 billion dollars. From the standpoint of the commodity markets, when you get an infusion of cash into the farmer's hand, he tends to delay his marketings. That tends to firm up the basis levels, the difference between the futures and the cash market, and keep grain off of the marketplace. And so as a result, that could delay any type of significant farmer selling. So that's one thing to keep in mind going forward. The second part of it is this deal with China that President Trump is promising when he meets with President Xi of China at the APEC conference in South Korea at the end of the month. Now, the question still is, will President Xi agree to some type of big commodity trade agreement ahead of getting a decision from the Supreme Court about the legality of Trump's tariffs? That decision is expected to come sometime early to mid-November. The opening arguments for the case are scheduled for, I believe, is November the 5th, with a decision to come in the days that follow. The court's trying to accelerate that decision. But let's say that we get there for after the decision. If the decision is against President Trump, and I think it's 50-50 which way that decision may go, If it's against President Trump, then President Xi has less incentive to sign a deal. If it's in favor of President Trump, and let's say you could still make an argument that Xi may want to hold out because he plays the long game. He may want to hold out for the midterm elections to see if President Trump loses Congress in the midterms, which is the historical tendency that the party in the White House loses votes in Congress in the midterm elections, and the Republicans, frankly, have very few votes that they can afford to lose in Congress. And so President Xi, who plays the long game, he looks at these things in matters of centuries. We look at them in terms of election cycles. He may simply want to hold out and bear the pain and not have to give up anything, so to speak. But if he does sign an agreement or agree to an agreement, and then the crushers begin to buy. It's mid-November. It takes 30 to 32 days for soybeans to get from the Gulf to China. We're certainly not filling trains with soybeans going to the Pacific Northwest for China right now. So from the Gulf 30 days, that means deliveries in mid-December. Well, Brazil will start harvesting its soybean crop in January. And by the way, planting is right on schedule there right now, with about 10% of the crop planted, about 17 to 18% of it planted in Mato Grosso. And so they'll be starting to harvest the earliest of those soybeans at the end of December. And so there's not going to be much of a window. Now, any soybeans at all that are sold will be positive for U.S. soybean demand. They're needed. That's desperately needed. Keep in mind that we do have anticipation of a strong biofuel program and strong domestic demand, record domestic demand. That's just not finalized until we get clarity on the RVO and the 50% blenders credit for imported feedstocks from the EPA. And with the partial government shutdown, that's likely delaying that work further. So we may not hear until this winter clarity on that. But the expectation is record strong domestic demand. That's not enough to make up for the lost Chinese exports if we lose any, but if we get any, that's a positive. The question is, how will we get any, and if so, how much will we get? So if you got an agreement in November, you might get some demand. Now, President Trump's talking about more of a blockbuster deal. My words, not his, but the terminology he's using, that's the type, what he's conveying is a blockbuster deal. Keep in mind that Chinese ports are going to be filled with Brazilian cargoes of soybeans in the first half, if not the first 2/3 of 2026, assuming that Brazil produces a normal sized crop. By normal, I mean normal yields on increased area being planted this year, about a 2% increase in area or so. So our estimates for this crop are over 178 million metric tons, which is up 10 million metric tons from our customer survey on the old crop in Brazil. So that's what about 370 million more bushels available in Brazil for this coming year if they have a normal growing season. Of course, we're just at the beginning of that. But let me ask you this question. If President Trump is so convinced that he will get a deal, and according to my balance sheet, which has optimistic domestic demand, if we increase exports to just 1.745 billion bushels for this current marketing year that started September 1, then we pull ending stocks down to 200 and roughly 250 million bushels for this ending stocks for this year, which would be a little over about 5.7% stocks to use ratio and justify national average cash price in the upper $12 range. If we had that, that would also provide upward support for corn as well, where we're seeing record export demand and maybe blowing away those records significantly. Would we even need the bailout, the 10 to 14 billion dollar bailout? Farmers would rather get the money from the marketplace than a handout anyway. So is President Trump's push for a bailout for farmers more of an acknowledgement of his lack of confidence of being able to get a trade agreement with China on the commodities? I think that's a serious question that we have to ask ourselves. Um, I hope he gets a trade deal. I hope that I'm wrong on that. But right now, I remain skeptical as I observe President Xi and how he's been managing this situation. So those are things we're watching this week. The flow of economic data is rather small this week. We do have a WASDE report that was scheduled for Thursday of this week. That's a world crop report. World Supply and Demand Crop Report. That has been suspended until further notice. Right now, we see no evidence of the shutdown making significant progress because neither party has the 60 votes necessary to bring a funding measure to the floor for a vote. So when you see that the both Republican and Democratic plans for funding government have failed, they haven't failed. They haven't even been able to vote on them because they failed to get enough votes to bring them to the floor for discussion and a vote. That takes 60 votes. And so we continue in that deadlock. No indication of a meaningful movement on that yet at this point. And it's my intention, or not my intention, but my belief that if we are still in a partial shutdown a week from now, that USDA will seriously be looking at canceling the October WASDE report as they did in 2013. So for that, I'll be back with you with further updates as they develop. This is Arlan Suderman. Be sure to like and subscribe if you want to continue to get these updates from the trading floor.